Hello, my dear students, and a very warm welcome back. I know, exams are just around the corner, and this chapter on share capital can sometimes feel a little heavy. But please don't you worry. In just the next few minutes, we're going to make this chapter so simple, so clear, that you'll be able to handle any question that comes your way. So, are you ready? Let's get started.
So, let's start with a question. We see these huge companies all around us, right? Tata, Reliance, building these massive factories, launching amazing new products. Have you ever stopped to think, where does all that money come from? We're talking thousands and thousands of crores of rupees. Well, a very big part of that answer is what we're going to study today, share capital.
Okay, so before we jump into all the journal entries, the debits and the credits, we first have to understand the main character of our story, the company itself. What exactly is a company? And what makes it so different from, say, a simple shop your uncle might own? Right, so here's the most important idea. The law, it treats a company like it's a person, an artificial person. You can't see it, you can't touch it, but in the eyes of the law, it's a separate being. It's not the same as its owners. This little idea gives it some incredible superpowers. And just look at these superpowers. A company can own buildings and land in its own name. It can sign contracts. But the biggest, most important superpower for people like you and me, the investors, is this one, limited liability. Listen carefully. This means if the company gets into trouble and loses money, the most you can possibly lose is the amount you paid for your shares. Your own house, your car, your personal bank account, all of it is completely safe. Now, isn't that a fantastic advantage?
Okay, now that we know what a company is, let's talk about the money. And to make it really easy, let's use a simple picture in our minds. Imagine that the company's total ability to get money is like a giant treasure chest. This whole chest, that's its share capital.
All right, first exam term. This is very important. Authorized capital. This is the absolute maximum, the ceiling, the total amount of money the company is legally allowed to raise by selling its shares. This is written in its main document, the Memorandum of Association. So in our example, this is the full size of our treasure chest. And to put a number on it, let's use the example from your book. See here? Sunrise Company Limited is authorized to raise a maximum of 40 lakh rupees. That's its registered capital. They cannot raise one single paisa more than this, unless they go through a whole legal process to change it. Now, does a company open the entire treasure chest at once? No, not really. They only offer as much as they need for now. So the part of the authorized capital that the company actually invites the public to buy, that portion is called issued capital. It's the part of the treasure they've decided to unlock right now. And then we come to what really matters. Subscribed capital is what the public agrees to buy. But the king of all capitals is the paid-up capital. As the name says, this is the money that has actually been paid by the shareholders. This is the real hard cash that lands in the company's bank account. This is the treasure that's actually inside the chest. Fantastic! So we've got the theory down. Now let's get practical. Let's actually follow the money. See how it travels from an ordinary person's pocket all the way into the company's bank account. This, my dear students, is where the accounting begins. The whole process is very logical, you see. First, the company sends out a prospectus. Think of it like a beautiful wedding invitation with all the details of the company. Second, people who are interested apply for the shares, and they send a small amount of money with it, called application money. And third, the company decides, okay, you get these many shares. That's called allotment, and they ask for the next part of the money. Okay, now I want everyone to pay full attention. This is a classic exam question. When all that application money comes flooding into the company's bank, what is the very first journal entry that we pass? Just think for a second. What's happening? And there it is, see? So simple. The company's bank account is increasing, right? So debit what comes in. Bank account, debit. And we credit a temporary account, a sort of waiting room for the money, called share application account. We're just parking the money there for a moment. Now, once the company decides who gets the shares on allotment, the real magic happens. We take the money out of that temporary waiting room, so we debit the share application account to close it, and we transfer it to its final permanent home, the share capital account. This is the moment it officially becomes the capital of the company.
A company is smart. It usually doesn't ask for the full price of the share at once. After the application in allotment money, it asks for the rest of the amount in parts, in installments, and these installments have a special name.
They're called calls, like a first call and maybe a second and final call. No, the logic for calls is a two-step dance. Remember this. First, we have to make the money due. We say, okay, shareholders, it's time to pay up. To do this, we debit share first call account and we credit share capital. We're just making a record that the money is now supposed to be paid. After this, when the money actually comes into the bank, that's when we'll debit the bank account. Okay, let's move on to the topics that, well, some students find them a little tricky, but I promise you they're not. Once you get the logic, they are very, very simple. And these are guaranteed to be in your exam, so let's become masters of them together, shall we? Just look at this slide. So clear. On one side, we have calls and arrears. This is just a fancy name for when a shareholder doesn't pay on time. It's unpaid money, simple. On the other side, we have calls in advance. This is the total opposite. Some very good shareholder pays their future calls early. So just remember, arrears means unpaid, advance means prepaid. That's all. Now, imagine this. This happens all the time in the real world. A very popular company offers, let's say, 2 lakh shares. But because everyone wants to own a piece of this company, they end up getting applications for 2.5 lakh shares. Oh my God, what do they do now? This situation, this has a special name. It's called oversubscription. Well, the company directors have 3 choices. Option 1, they can just accept the first 2 lakh applications and say, sorry to the rest, sending their money back. Option 2, they can be very fair and give a few shares to everybody. So if you applied for 5 shares, maybe you get 4. This is called Pro-Rata Allotment. Or option 3, which is the most common in exam questions, they do a mix of both. They might completely reject some people and then do a pro-rata allotment for everyone else. Phew, we've covered a lot of ground. So before we finish, let's do a super quick, lightning-fast revision of the absolute most important points, the things you must remember for your exam. Are you ready? Let's go. Okay, let's do this fast. 1, company is an artificial person. 2, money comes in parts, application, allotment, calls. 3, the golden rule for journal entries is due then received, always. 4, oversubscription means too many applications. 5, pro-rata means giving everyone a fair, small piece. And 6, calls and arrears is simply money that's late. If you know these things, my dear students, you are in a very good position. And that is a wrap on our quick explainer for share capital. Please remember, you have prepared so well. You know this subject. When you go into that exam hall, just be calm and confident. Trust in your preparation, read every question carefully, and you will do wonderfully. All the very, very best, my dear students.